Hello everyone, and welcome back to the channel. Today, we're diving into the dramatic and enlightening story of a true market titan, one of the greatest traders to ever live, Jesse Livermore. His life is a whirlwind tale of spectacular riches, devastating losses, and profound lessons that are just as relevant today as they were a century ago. Livermore wasn't just playing the stock market, he was pioneering the art of speculation. Blending sharp intuition with ironclad discipline, at his peak, he controlled a fortune worth an estimated $1.5 billion in today's money. It's an incredible figure that speaks volumes about his mastery of the market's pulse. So, how did he do it? And more importantly, what can we learn from his incredible journey? Let's find out. Livermore started his journey in the late 1800s, not in a fancy Wall Street office, but in what were known as bucket shops. These were essentially gambling dens where people bet on stock price movements without actually owning any stocks. It was here, as a teenager, that he honed his skills. He wasn't just guessing, he was meticulously recording price movements in his personal ledger. Searching for patterns and repeatable behaviors, he quickly realized that stocks, like people, have distinct characters and tendencies. This early practice of pattern recognition and data analysis became the bedrock of his entire trading philosophy. By the age of 20, he had already made his first $10,000 of fortune back then and earned the nickname, the Boy Plunger, for his bold, high-stakes bets. He was quickly banned from most bucket shops because he won too consistently, forcing him to move to the real deal, Wall Street. Once on Wall Street, Livermore applied the same principles, but on a much grander scale. He developed a set of trading rules that are now legendary. One of his most famous maxims was, "The big money is not in the buying or the selling, but in the sitting." He understood that true wealth in the market comes from identifying a major trend and having the patience and conviction to ride it out, rather than jumping in and out for small profits. He also believed in cutting losses quickly. If a trade went against him, he wouldn't hesitate to sell, saying, "I never argue with the tape." This emotional detachment was his secret weapon. He treated trading as a business of probabilities, not a game of hope. He famously shorted the market before the great crash of 1907 and the even more infamous crash of 1929, making over $100 million in a single week during the latter, an act that cemented his status as the Great Bear of Wall Street. But through it all, he forged a set of timeless trading principles that are just as powerful today as they were in the early 1900s. These aren't just tips, they're the battle-tested rules of a market titan. To stick with me, because understanding these could fundamentally change the way you see the markets. Let's start with a rule that keeps you in the game. Cut your losses early. Every great trader knows that survival comes before success. This isn't just a tactic, it's a non-negotiable mindset. The market doesn't care about your hopes, your opinions, or how much research you did. It only speaks one language: price. When the price moves against you, the market is screaming a simple message: you're wrong. The longer you ignore the message, the more you pay for your stubbornness. Livermore often said that hope is the most dangerous emotion in trading, and he was right. Hope has destroyed more accounts than any market crash. It's the little voice that convinces you to hold a losing position, praying for a miraculous rebound that rarely comes. Professionals don't operate on hope, they operate on discipline. They accept that small losses are simply the cost of doing business. Think of it this way: a trader who refuses to take a small, manageable loss will eventually be forced to take a catastrophic one. Cutting a loss isn't a sign of weakness, it's the ultimate sign of strength and humility. It's admitting that, in this moment, the market knows more than you do. Livermore believed your number one job as a trader is to protect your capital. Your capital is your ammunition. Without it, even the most brilliant strategy is useless. Every single dollar you save from a small loss is a dollar you can deploy on the next real opportunity. When a trade goes sour, you have to act decisively, without hesitation. The best traders define their stop-loss, their line in the sand, before they even enter the battle. They don't negotiate with it, they don't move it further away, and they never let emotion overrule logic. Livermore's own life was a testament to this rule. Every major financial disaster he suffered came when he broke his own code and failed to cut his losses early. Remember this truth from the master himself. It is not the loss itself that kills you. It is refusing to take it when you should. Now for the second principle, and it's a game changer: trade the price, not the news. Livermore built his empire not on crystal ball predictions, but on pure, unfiltered observation. He didn't trade headlines or opinions. He traded what the price was actually doing. For him, the price on the ticker tape was the ultimate source of truth. Everything else, news reports, expert analysis, market sentiment, was just noise. He understood a concept that's central to modern finance: the market discounts everything. By the time a big story hits the front page, the smart money has already acted, and that action is reflected in the price. Livermore was watching this happen in real time, decades before sophisticated charting software even existed. He would study the ticker tape, watching how price reacted to buying and selling pressure, how it paused at certain levels, how it reversed, or how it broke through to new highs. His decisions were rooted in this direct observation, not in speculating about why something was happening. He developed the concept of pivot points, critical price levels, where the psychology of the crowd was shifting. When a price broke decisively above a key resistance level, it was a signal of strength. He would buy. When it failed to hold a breakout and fell back, it was a signal of weakness. He would sell. He didn't argue with these signals. He obeyed them with military-like discipline. This approach allowed him to ride massive, powerful trends and avoid getting whipsawed by emotional reactions to news. Trading the price forces you to be detached and to accept that the market is always right. When you trade based on a news story or an analyst's opinion, you're essentially trying to outsmart the collective wisdom of millions of market participants, a losing game. But when you trade what you see, you align yourself with the market's actual behavior. In today's world, with social media and a 24/7 news cycle creating an endless fire hose of information, this rule is more vital than ever. Ignore the noise. Watch the price. As Livermore famously said, the market is never wrong, opinions often are. Finally, we arrive at the principle that creates fortunes: let your profits run. One of Livermore's greatest and rarest skills was his ability to sit still and do nothing when he was right. He knew that the truly big money in trading doesn't come from 1,000 tiny wins. It comes from patiently capturing large, explosive trends. This is the heart of his third rule. Most traders make the fatal mistake of snatching small profits the moment they appear. They're terrified the gains will vanish. But Livermore understood that true wealth is built on patience and conviction. He famously said, "It was never my thinking that made the big money for me. It was always my sitting." Think about that. The hardest part of trading isn't finding the right entry. It's having the psychological fortitude to hold on while the market moves powerfully in your favor. Fear will whisper in your ear, "Take the money now before it reverses." But discipline replies, "Stay with the trend until there is a clear reason to exit." Livermore always listened to discipline. He explained this with his fish principle. He said a trader can never catch the entire fish. You'll miss the head and the tail, but your goal is to capture the thick, meaty part in the middle. That middle section represents the main body of a trend, the period where the market moves most reliably in your direction. Trying to perfectly time the exact top or bottom is a fool's errand. It's gambling. The professional's job is to identify a confirmed trend and ride it. Letting profits run doesn't mean being greedy. It means trusting your analysis and understanding that trends often go on for far longer and move far further than anyone expects. Livermore would even pyramid his positions, meaning he would add to his winning trade as the market continued to prove him right. He only increased his bet when momentum was on his side, turning a good trade into a life-changing one. To succeed like he did, you have to let cold, hard logic override your fear. Use tools like trailing stops, watch the price structure, and give the trend room to breathe. Jesse Livermore's legendary success wasn't built on being a frantic day trader. It was built on his incredible patience to wait, to hold, and to squeeze every last drop out of a big winning move. As he said, the big money is made in the big swing. So there you have it, 3 core tenets from one of the greatest traders who ever lived. Cut your losses without hesitation. Trade what the price is doing, not what people are saying, and have the courage to let your winners ride. These rules are simple to understand, but take a lifetime of discipline to master. Let's start with principle number 4, a rule that could save your entire trading account. Principle 4, never average down. To Livermore, this was the ultimate sin. It feels so logical, doesn't it? If you like the stock at $100, you should absolutely love it at $90. But the market doesn't care about your logic. When a price moves against you, it's not an invitation to buy more. It's a warning sign. The market is whispering that your analysis might be wrong. The professional listens to the whisper. The amateur argues with it, doubling down, turning a small, manageable mistake into a potentially catastrophic one. Livermore believed you should only add to a position that's already squawking. Proving you right, that's called pyramiding your profits. Adding to a loser isn't strategy. It's an emotional attempt to prove you're right. The market doesn't care about your pride. Livermore's rule was simple. When you find yourself on the wrong side of the market, the only thing to do is get out. Survival matters more than being right. This leads us to his 5th principle: study market behavior, not your emotions. Livermore was a pioneer in understanding that markets are driven by human psychology, greed, fear, and hope. He knew that charts are just visual records of crowd behavior. So, to study the market is to study how people act under pressure. Most traders get this backward. They spend all their time analyzing their own feelings, trading out of boredom, excitement, or a desire for revenge. But your emotions are the enemy. The market is neutral. It's your interpretation that makes it dangerous. Livermore trained himself to be a detached observer. He watched how the market reacted to news. Did it refuse to drop after a bad report? That signaled hidden buying. Did it fail to rally on good news? That suggested exhaustion. He found truth in the market's behavior, not in headlines or his own feelings. You must learn to think independently, because as he famously said, markets are never wrong, but opinions often are. And how do you find those perfect moments to act? That brings us to principle 6, patience is a position. Livermore often said, there is a time to buy, a time to sell, and a time to go fishing. Sometimes, the most profitable thing you can do is absolutely nothing. The best opportunities are rare, and they take time to develop. Most traders feel like they always need to be doing something, chasing every little move. But Livermore knew the market pays the patient, not the restless. Sitting on your hands, preserving your capital until the perfect setup arrives that is a trade. He compared it to waiting for the ocean tide. You can't force it, you have to wait for the current to turn in your favor. He would sometimes sit out for weeks, just watching, waiting for that perfect alignment of price, volume, and timing. Then, and only then, would he act with conviction. As he put it, money is made by sitting, not trading. In the quiet moments between trades, that's where true mastery is found. So, you're patient, you're watching the market's behavior. But what are you looking for? Principle 7 gives us the answer. Markets repeat because human nature never changes. This was Livermore's most profound insight. Technology evolves, news cycles change. But the core emotions driving the market, greed and fear, are timeless. Every boom, every bust, every panic is just a variation of the same psychological pattern he saw 100 years ago. He studied market history and saw the same behaviors repeating again and again. In every bull market, people say, this time is different. And in every crash, they believe it's the end of the world. Livermore learned to profit from this predictability. When euphoria was rampant, he became cautious. When despair took over, he looked for opportunities. This is why charts from the early 1900s can look eerily similar to today's markets. The players change, but their instincts don't. The game doesn't change, and neither does human nature. Okay, so the market is repeating its patterns. Where should you focus your capital? This is Principle 8. Ride the leaders, not the laggards. Livermore knew that strong markets are led by strong stocks. The leaders are the ones breaking new highs, attracting big institutional money, and setting the trend. The laggards are the weak ones struggling to keep up. Most retail traders do the exact opposite. They buy the weak stocks, hoping for a turnaround because they seem cheap. But Livermore knew that the cheap often get cheaper and the strong get stronger. A stock that's consistently outperforming isn't lucky. It's a sign that smart money is buying it up. You have to have the courage to buy stocks that already seem expensive, because those are the ones with the momentum to go even higher. Following strength means you're aligning yourself with the real money flow, not just wishful thinking. The leader is the message, the laggard is just an echo. Now, even when you're riding the leaders, you will have losing trades. How you handle them is what separates the professional from the amateur. This is Principle 9. Control risk like a businessman. For Livermore, trading wasn't gambling. It was a serious business. Your capital is your inventory, your trades are your products, and your stop losses are your insurance. A businessman would never risk his entire company on one deal. So why would a trader risk their whole account on one trade? Before every single trade, Livermore defined his entry, his exit for a loss, and his position size. He calculated exactly how much he was willing to lose before he even dreamed of the potential profit. He treated losses as a cost of doing business and expected operational expense. As long as those costs were controlled and kept small, they could never threaten the entire enterprise. The amateurs focus on profits. The professionals focus on risk. And in the long run, the ones who manage risk are the ones left to collect the profits. Finally, we arrive at the most important rule of all, the one that ties everything together. Principle 10. Master yourself before you master the market. You can have the best system in the world, but every decision you make has to pass through the filter of your own mind. If that filter is clouded by fear, greed, hope, or ego, you are doomed to fail. Livermore made and lost fortunes, and he admitted his biggest losses came not when his system failed, but when he failed to follow his system. He let emotion take over. He understood that trading is an internal battle disguised as an external game. Can you stay disciplined when you're in a losing streak? Can you avoid getting greedy after a big win? Mastery is the ability to execute your plan with cold, rational consistency, no matter how you feel. In the end, you don't conquer the market. You conquer yourself, and for that, the market rewards you. These are the timeless principles from one of the greatest traders who ever lived. They require discipline, patience, and a deep understanding of both the market and yourself. Thank you so much for joining me on this journey through Jesse Livermore's wisdom. If you found this valuable, please hit the like button and subscribe for more content to help you on your trading journey. See you in the next video.